The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, again, on Wednesday, the grain rally and livestock, too, really couldn't hold as we went through the day. We worked off the session highs, so what exactly happened there? Plus, we got the consumer price index data out, and with that coupled with this week's PPI data kind of showing that sticky inflation still hanging around. We got a lot to talk about. Let's talk about it here on the show with Mike Zuzolo from Global Commodity Analytics joining us here today. Mike, it is good to be back this week and good to catch up with you. Thanks for joining us. Hope you're doing well.
Doing great. Congratulations to you and Katie on the new little one, Jesse. Proud papa, I'm sure.
Proud papa indeed, and the sleep is few and far between, but we're making it work. So that's just, I know that's how it goes, but definitely good to be back. Everyone happy and healthy. And I was joking with you a little bit before we went on the air. I missed a lot of the fun action last week in the markets. And you know, a little bit of a rally continuing Tuesday, but then Wednesday we started higher and then just kind of hit a stop sign, it felt like, and pushed back to the downside. Just felt like kind of a profit-taking type day in grains on Wednesday, Mike.
Yeah, and it was interesting because Wednesday's trade was split up in the wheat complex compared to, and the corn for that matter, compared to Europe. I mean, we're still dancing near $6 a bushel equivalent in Paris corn right now, and we were down just a smidge on Paris wheat on Wednesday. But we here in this country probably had to deal with the crop quality tour and what we saw in terms of the hard red wheat tour here in Kansas, and that day one number coming in at almost 50 bushels an acre. And that compares to, I think, a 42.7 yield. And this is northern Kansas, 42.7 for a 3-year average. I think when the trade saw that, they recognized that USDA's numbers from last week are probably closer to being right than maybe they were thinking given the crop conditions reports. Now, having said that, I think this number is going to change pretty dramatically when it's all said and done. I'm hearing, I don't know this for a fact, but I'm hearing that some of the participants are having a difficulty picking up the white heads, the frosted, the freeze-bitten heads. And I think that's something to be very watchful of. And I'm not saying that the wheat should make a complete turnaround in terms of just on the Kansas crop tour mindset, Jesse. But I guess what I am saying is Europe is still in the driver's seat, and we're still trying to get an idea of how badly hit Russia is. And I'll end it this way. When it comes to the wheat and the big picture, I still think we can have another leg up in this market. This is something you and I have talked about, a 2009 type style market. Wheat leads us the first half of the month, and then we have a top in the market in the dollar, and that dollar peak comes in and gives us that second move to the upside. And I think that's really crucial against the Russian ruble, the Brazilian real, and the Chinese yuan. If we could see that manifest itself, then I feel fairly good about another leg up, a leg that I want to sell, though.
Well, you shared some good analysis with us here today, and I want to pull some charts on the video feed. And first start with the consumer price index and the producer price index. I think this is going to help frame up our grain discussion here a little bit more today. I mean, CPI looked like it was as expected Wednesday. The PPI was a bit hotter. The sticky inflation environment just feels like it's hanging around. What are some things you took away from this week's data and how it is playing into the broader market picture, Mike?
Yeah, when it came to the CPI number that came out on Wednesday, we really saw the gasoline, unleaded gasoline, and shelter come in, and I think they were essentially 70% of April's CPI number. When we look at the, the PPI number, when we look at the PPI number, you see it going higher. And so while the gasoline and the shelter kept the CPI above 3.4, 3.5% a year over year level, 3.4 for the overall, 3.6 for the core CPI. We saw the PPI take a directional shift to the upside on Tuesday. This makes sense because raw material prices are going higher. And this really resounds with me, Jesse, because we've had that record high in gold, that record high in gold in the spot market has now been joined by a fresh all-time record high in the copper price at the London Metals Exchange of going over $5 a pound. And so I think the PPI is going to continue to run hot. I think that should be beneficial to commodities. The only caveat I would throw out here, and we don't have to go into a lot of detail on today's show, but would be a good reason to pick up a trial or pick up a subscription, is we have seen the United States move very aggressively against China on fresh sanctions on EV batteries. They've quadrupled the tariff to 100%. They've doubled the tariff on Chinese computer chips to 50%. They also increased the medical supplies coming from China. That's going to keep your inflation hot, but it's the wrong type of inflation. It's the inflation due to tariffs, and that's not a good signal for high inflation when it's not really led by the demand side of the equation. So somewhere down the road, we're going to have to worry about inflation running too hot in the commodity markets. And because we're going after China more, and we're talking about going after Mexico more in terms of import tariffs on certain goods, I really think agriculture could continue to have a target on its back. And this is why I said in the beginning of the comments that if I can get that second leg up in the second half of May, I will want to recommend hedges with clients because of the election and these trade frictions.
And those trade frictions, like you said, we don't need to get into that rabbit hole. We'd spend 30 minutes on it. But when I think about China trade war, I think soybeans first. That's a big one for me that I worry about there. But you mentioned the leg higher. You brought this up just a little bit ago. Pull up a chart here, wheat, US dollar, just to have you kind of reiterate to us your thoughts here as you kind of look at the comparison between these two.
Yeah, what I really wanted to do here with your help was to say, okay, let's visually look at this market. And we've looked at this chart before several times this past year because we now know we have a 10-year low in stocks to use ratios globally. That almost $7 level we've hit in soft red wheat on this chart was done on Wednesday's trade. And so we have touched close to $7 again. Now the soft red wheat is positive. What we want to see is the orange line, which is the US dollar, go lower now because it's very rare to see a positive wheat market on the year. And that's what this is, an annual chart. It's very hard to get a green bar on this chart in the wheat without the dollar, that orange line, heading lower or spiking lower or making a major top. So that's the second domino to fall here, as I said, the second half of May.
Another chart I want to pull up here, looking at corn world stocks to use. And obviously, of course, we had Friday's May WASDE reports and kind of digested those numbers. And, as we look at that and then look at this chart, I mean, what's your big takeaway here in this corn market overall, Mike?
My big takeaway is USDA is moving in real time with these numbers. And you and I have talked about the idea that it wouldn't take much, a 10 million metric ton cut. And they ended up doing, I think, 5 or 6 on their WASDE report, but they also increased demand. And all of a sudden, lo and behold, because we've been running at about 26% stocks to use ratios for the last 5 years, all of a sudden we're running an 8, 9, 10-year low now in the corn stocks to use ratios, just like we are in the wheat. And so now we know that the world stocks of grains, wheat, and corn are exceptionally tight. They're at decade low levels when you factor in the demand side. And this should resonate with producers, especially, Jesse, when we look at soybeans. If USDA is right and we have a 445 carryover here domestically this year in soybeans, when we look at this chart compared to both the US soybean stocks to use and the world stocks to use for soybeans, beans should not be leading this market higher. They probably should be leading it lower. And I think that was the anomaly on Wednesday, was beans tried to lead it all by themselves again. And we see where that got them. And that was especially kind of driven home with a real disappointing April NOPA crush number that came in about 10% less than what the trade was expecting.
Yeah, that NOPA crush number, I wasn't a fan of that. And again, overall, just kind of a down day in the grain trade on Wednesday's session. We're talking with Mike Zuzolo from Global Commodity Analytics here on today's Market Talk. And Mike, you mentioned this a little bit earlier as well, looking at, with the CPI and PPI numbers, looking at gas, unleaded prices. Let's look at the Midwest diesel price. This is something we haven't touched on in quite a while. What are you seeing on this chart? Let's take a dive into this, Mike.
Yeah, seasonally, you're going to have a tough time getting the diesel price much lower than it is right now until you get past the third quarter. You add to that the fact that we're touching around 375, 376 a gallon on the retail side of the Midwest price. That gets you back to 2012, 13, 14 levels after scaling fresh highs for the essentially the decade plus after the pandemic time period. I think what I'm seeing right now, Jesse, is the idea that if the dollar is going to make a high, it's going to be much more difficult to pressure the energy markets at this point. And I think it's also very important to realize that the leaders of Russia and China are going to get together this week, and we're not doing well when it comes to the Middle East in terms of what's happening with Israel and the regional war that could still be very much looming in that region. So I think we've taken out the geopolitical risk in the world energy markets. If the dollar makes a high, I think it's going to be exceptionally difficult for the energy markets to get much cheaper. And that's why I wanted to focus on with the clients and the higher level subscribers, sending out a text blast on Wednesday before the market closed to get essentially their diesel prices locked in through September. You can do some unleaded, but as you said, that CPI number showed us 2 months in a row of higher unleaded prices. You could probably let that float a little bit for another 30 days. But diesel prices, I think, when you look at this chart of the last 10, 12 years, it seems to me we're at a pretty decent level. And if you want to go lower than where we're at right now, what this chart says to me is you're essentially banking on deflation or recession. And I just don't want to put my clients in that situation heading into the fall harvest.
Well, and have to think that maybe that bulk diesel tank's been getting depleted a little bit here with planting this spring. So why not fill it back up and lock in some prices? I think that's a good idea. Let's go to livestock. I want to spend some time with cattle here. Really strong day Tuesday. Then Wednesday was kind of just, it felt like that risk off, kind of pullback mindset along with the rest of the markets. Let's start with this cash cattle futures chart first. Talk to me about what you're seeing here, your overall sentiment in this cattle market. I know box beef has looked pretty good so far this week, things like that. But what are you seeing on this chart? How are you feeling about cattle right now, Mike?
Yeah, you brought up a huge point. The box beef, the choice looks like it's made a real bottom against the select. It's upwards of $10 premium again. I think that's supportive. The lack of HPAI in the news is supportive. Memorial Day packer buying should be red hot right now. The corn market weakened on Wednesday. That should open up the feeder prices again. But most importantly, this chart right here really shows us that we've got a 184 cash price, negotiated cash price. That is right within actually right where USDA put us for Q2 on last week's WASDE report. For Q2, they went from 185 last month to 184. They took us down $1. So if you say 184 is a fair value for this market, which I think it is, then you have a $5 to $6 upside theoretically then in the June fat cattle market. I think this is the time where we would want to close that gap, Jesse. And so I see grains and livestock very much almost the same way right now, short term, looking at a second half of May rally. And if I don't get it, I'm going to start to get really, really nervous that we may be preparing for a whole nother leg down, because again, the funds are essentially flat in the feeders, lightly net long in the fat cattle. They shouldn't need to reduce that much of their positions at this point, especially given the seasonality and the summer grilling season coming on.
One other chart to share, June cattle. Walk us through, kind of tie this chart in with the last one here, Mike, and just add to your thoughts here right now.
Yeah, the thing here is that my undervalue level, we're trying to test again about 179. My overvalue is all the way up at 190.43. That's based upon supply demand fundamentals of production and what I think the dollar should be at. And so if you split the difference, you come in at that 184, 185 level. 184 is a trend line, 185 is the old highs. It would make sense that we would try and go after that again and test that and resolve ourselves that that's the top of the market for right now. And if not, if we can break 185, you have very little resistance above 185, 186. So my overvalue level, I think, could be on the table. So if you can get to 184, 185, start laying in hedges and then be done by the time you get to 190. But this is an interesting chart because we've been able to get back up above the 40-day moving average. We're testing, getting into that area of really close, tight-knit resistance that's been keeping us under wraps for about a month since the HPAI came in. And what I'm sitting here thinking to myself, Jesse, is why can't we break through that mid-April level and go back to where we were with that cattle on feed report that showed that tighter supply? So that's the logic I have in kind of visualizing it in this chart.
That hog market too. I know that hog market's been a little scary here as of late. Was up Tuesday, then back down Wednesday. With cattle, with beef demand, pork demand, we're getting into that Memorial Day window here. I mean, hogs, are you concerned, I guess, about this hog market right now? How futures have been looking, the cash side, et cetera. What's your thoughts on this hog trade, Mike?
I've had the view that we've got a lid on the market in the 100, 102 level until the dollar breaks lower. I still hold to that because I still see pretty good news coming out of China. They've moved again this week and last to clean up their property market in a real manifest way. They're looking at really taking it over and completely getting that situation under control from what I'm picking up in the Asian markets. The Asian sources that I have, I should say, Jesse. So I think hogs are still a lot about China and then obviously the dollar. And if we can break lower in the dollar, we may be able to go back into the $100 plus level. I do think that when you look at some of these earnings numbers and earnings reports from, say, the Tysons, the JBSs, they're very excited, if you will, on the pork side of the equation because they think it's kind of positioned well both in price and supply compared to beef. So I think pork should have a good summer grilling season and be kind of second, right next to being second to the beef at this stage of the game.
Well, I want to wrap this up, Mike. Final thoughts from you. We got a couple minutes here. Overall, my feeling here, and I know one day doesn't make a trend, but I think Wednesday was a good case in point. Grains, livestock, you name it, that these markets have been rallying, but they are hitting some points here in many of these markets where it feels like there's a top or some overhead resistance, things like that. There's some farmer selling going on, et cetera. So it feels like this is really a point that a lot of folks can maybe look to protect some of their risk here in this window, right, Mike?
I think that's a really valid point, especially when it comes to the soybeans, because you've got a lot of factors out there that would suggest that soybeans are going to have a tough time going higher without the help of the other markets. They can do what gold and copper did, but I would say you're probably going to have to do that with the leadership of the wheat and the corn. And I would just say, Jesse, at this stage of the game, knowing that we're almost planted, and I know we're having difficulty, but knowing that we're almost planted, I really do think we've done a good job of factoring in that tighter supply. We could go higher, but I think it goes back to opening up the demand side. And I think that goes back to the currency markets and the investor funds and their investment demand coming into this market. Instead of being net short 290,000 contracts of corn, be net long 290,000 contracts of corn. How are we going to get there without a drought? And that the answer is the currency markets. And drought looks pretty tough at this point.
Equip yourself with knowledge. I think that's the big thing, and don't be afraid to make some moves and some decisions, even if you're a penny or two off of what your target is. Hey, that's not a bad point to be. And Mike, thinking about equipping folks with knowledge, they can reach out to you. You got a lot of great research. You mentioned the free trial and more. Where can folks get more information about you and all the work you do there at Global Commodity Analytics?
Yeah, with planning, I just extended the free trial to 2 weeks. So go to globalcomresearch.com, and that's globalcom with 2 M's research.com. And don't hesitate to give me a call if you need to. The toll-free numbers on the website, as is our product services brochure.
Well, and as always, the risk of trading futures and options can be substantial. Make sure you take that risk into account as you are working on your marketing plan. And again, you can reach out to Mike Zuzolo for a little advice if you need it. With that, Mike Zuzolo, Global Commodity Analytics. Always good to talk with you, sir. Thanks for joining us this week.
Thanks, Jesse. Have a great week and nice to have you back.
I appreciate it and happy to be back. That's going to do it for Market Talk here today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.